right next to our studios in New York City. It's 11 o'clock Eastern Time. It is Tuesday, October the 4th. And it's a rally, folks. Just look at this. Gaining a little more ground. And the Dow now up 740 points, 2.52%. NASDAQ up 360, that's 3.3%. Big tech across the board doing very well. Thank you very much indeed. We've got Amazon up 5.9%. Microsoft, 3.5%. Alphabet, 3%. Apple, 2%. Meta, 2% higher. The 10-year Treasury yield, right at the center of the action today, it's all the way down to 3.58%. Now you know why big tech's doing so well. Mike Lee joins us this morning. Is this just a bounce, or is there something more to it here?
Well, Stuart, I tend to believe there's something more. And I believe that something is going to change with the Fed. And the reason why something is going to change is because since the start, they've been talking about a soft landing. And a soft landing doesn't mean stock markets only go down 1% or 3%. It means that assets move in an orderly fashion and markets don't seize up a la 2008. Well, that has been the case until last week when UK pension funds needed to be bailed out by their central bank. So these pension funds abroad are centralized. There's not hundreds of thousands like there are in the U.S. There's generally one central one for most of these countries, and they buy long-term bonds to match their asset liabilities. And those long-term bonds were selling off dramatically, and the central bank had to come in and bail them out. And then you combine that with Credit Suisse. It's not only the Credit Suisse and the UK pension fund, there's also other pension funds abroad having these issues. The UN's out yesterday. So markets are starting to seize up, and that soft landing is no longer looking like a possibility. This has led the market to believe that they will pivot, and hopefully we have seen the bottom.
Can you explain why the yield on the 10-year Treasury has dropped below 3.6%? Is it a recession indicator, or is it a flight to safety of some sort? Which is it?
Well, I think it's both of those plus a Fed pivot. So you're still going to see this inversion. We are still looking down the barrel of a recession, but on about August 1st, the expectation for Fed funds rate for February of next year was 3.25%. That has moved to 4.75% today. If that changes, which looks like the stock market and the bond market is betting, that means interest rates are going to be a lot lower, making stocks a lot more attractive. And then this Fed raising front-end interest rates to maybe 3.75% or 4% versus 5% plus over the next 6 to 9 months is a huge deal to markets.
Okay, a huge deal for the markets. We shall see. Mike Lee, thank you very much, sir. Appreciate it always.
Thanks, Stuart.